You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. All right. Well, today we are taping Options Playbook Radio. It is Wednesday, March 10th. The markets are open and they are rocking upward today. We do see the VIX index come off a little bit overall, but there's been some weakness in the marketplace going into the last few days of the market. We did get some decent inflationary news, and that inflation is not as big of a concern at this point in time, and that's really what has spiked the market upward. Inflationary concerns were probably the biggest reason for the downturn overall, and the sell-off in general in NASDAQ/tech stocks or stay-at-home stocks. So last week we looked at Zoom. Zoom Communications, obviously one of the big beneficial companies of the pandemic, has done very well since the March downturn of last year, which we're approaching the 1-year anniversary date of overall. But with that said, we thought about doing a cheap speculation trade on Zoom last week, and it could have worked out. It wasn't perfect overall, but we did get a downturn in Zoom after we talked about it. So I'll just review the trade real quick like in that. We looked at a shorter term butterfly, a standard butterfly in Zoom Communications. Symbol was ZM. We went out till March. The stock was trading at 341.57. And guess what? It's pretty much at the exact same place right now, 341. We bought the 300 strike put, sold the 280 strike put, and bought the 260 strike put, all with the same expiration, of course, which is the March 12th expiration, which is coming up here soon. The stock has gone down and came close to that 300 level, but it's now bounced back, as I mentioned, trading fairly close to where we were looking at it last week. So there were many opportunities to get out of the trade. And one of the biggest things we talked about on Options Playbook Radio was when we look at butterflies, don't expect a home run. It's not a home run type trade. If you can double your money or do even a little better than that, you're doing really well. So that's the approach that you should have taken. And you should have gotten out of the trade previously because there were opportunities to do so. It was trading at the midpoint when we put the trade on of 75 cents. So that meant for every 1x2x1 butterfly that you put on, you were charged 75 cents plus commission to put on that trade. And that was going to be your total risk of your trade. And it really was just a speculation trade overall, saying there's some weakness in the marketplace. The stocks that are getting beat beat up the most are the ones that did well during the pandemic. So let's take a speculative look at an out-of-the-money butterfly in an expensive stock like Zoom. And we talked about butterflies are cheaper when volatilities are higher. And also when you're dealing with expensive underlying stocks, a lot of times a butterfly is a cheap way to speculate on a particular direction of an underlying stock. And with Zoom, we were looking to be bearish. Now, not meant to be a recommendation, and nothing ever is on Options Playbook Radio. When we talk about these strategies, we have over 40 different strategies inside the Options Playbook. And all we're saying is these are the conditions where this strategy might apply. And we're trying to beat home the fact that there is no golden book of answers when it comes to option strategies. You look at what's the price of the underlying, what's the volatility, what is the best way to approach my forecast for the underlying using options to try to take advantage if my forecast is correct. And in Zoom, if I go back and I'm just going to look at the chart real quick, we put this trade together. It was March 3rd. The market was closed at that point in time. And if I just look quickly at the Ally Invest charts here, we see that on that day, the stock closed at 341. The low since that point in time, the low trade was 314.38, and that occurred on the 5th. So if you missed that opportunity, stock bounced back, came back towards the 330 mark, but then came back down again, and it ended up closing the next big downturn. The low for that day was 324.25, and that was on the 9th. And then after that, it traded fairly basically to the upside. And now here we have it trading actually right now at 340, rounding off. So in general, there were opportunities, but it never did get to the 300 strike overall. But if we were looking at the price of the butterfly, the downward movement in that stock on those 2 different days should have gave you an opportunity to get out of the trade. And we did say that we're managing our risk by doing the butterfly. So it really was a speculative all or nothing type trade. Now, with that said, if I miss those things and I see right now it's trading for right around 20 cents, I might just sell it and get out today because there's only a couple of days left. But overall, I would probably just stay in the trade and let it ride. It was $75. We managed the risk by doing a 3-legged trade. And for every 1x2x1 butterfly, we were risking 75 cents. And we knew that when we put the trade on. Plus commission. Always have to add that in. We don't want to forget about commissions overall. All right. So today, let's look at a more basic trade. I don't have many opportunities to talk about basic trades overall. This is a little bit more of an intermediate type podcast, I would say, and especially because we're talking to the options insider crowd, which I think is a little bit more astute listener overall in the options marketplace. I love what Options Insider does overall. And so with that said, I'm going to look at just an interesting way to play Johnson & Johnson. Now, Johnson & Johnson, if I look at the chart, has obviously been in the news. They're one of the companies that has came up with a vaccine. If you don't know that, right, this is your first time hearing that, you've probably been living under a rock for a couple of months. But overall, a lot of people are big on the Johnson & Johnson vaccine because it doesn't need intense refrigeration, and it's one shot. So you got to think about the rest of the world and distributing this vaccine. Obviously, they're going to lean towards the Johnson it's not obvious. I'm going to say you would think they might lean towards the Johnson & Johnson vaccine overall, mainly because the distribution is simpler for their vaccine. So when I look at Johnson & Johnson and just looking at the chart, there's been some volatile movement in this pharmaceutical overall ever since the pandemic. I mean, to the downside and the velocity to the upside. Now, it was definitely, in my opinion, in hindsight, looking at a, buy the rumor, sell the news scenario, in that if we go back to February, the end of January, beginning of February, we actually saw the 52-week high in Johnson & Johnson hit 173 approximately. And then it didn't take long for it to actually go back down. And it's gone down precipitously, all the way down to where just on March 4th, we saw it trading at the recent low of 151. And now we're bouncing back again, 159. So you have a lot of volatility in the underlying. It might be a buy and hold if you're thinking that direction. The stock isn't that pricey. It's not inexpensive, but $159 stock. That's where it's currently trading at. And as I mentioned, we are taping. The markets are rocking and rolling right now, and we are taping on March 10th, a Wednesday. So the stock I'm going to round off is right around 159. That means it's going to cost you $15,900 to buy 100 shares of it. So I want to just look at buying in the money leap. One of the biggest things about buying in the money leaps, and I like to bill it as buying leaps as a substitute for owning the stock outright, is the width of the markets if you go a little bit further out in time. But one of the benefits of having a solid company that where the underlying stock has good liquidity right now, and it being in the news, is that the markets on the longer term in the money options are okay. So once again, on Options Playbook Radio, it's not about this is the best option strategy. It's about looking at options and picking a strategy based on what is going on in the underlying stock. So what have we seen happen in Johnson & Johnson recently? Well, a lot of the news has came out. We know they have a vaccine. We know that it's a one shot. We know that it doesn't take the refrigeration process. We know that they're trying to distribute it out to the rest of the world. McKesson is one of the companies that is helping with that. Obviously, you got FedEx, you have UPS. Those are the two main companies that they're using to actually ship the vaccines across the world. So you have all these steps in place, and what has happened is the volatility has actually kind of came off. The actual volatility of Johnson & Johnson stock and the implied volatility has kind of settled down a little bit more recently. So we see on a 30-day basis right now, we see Johnson & Johnson trading below the VIX. If you can figure that out, it's right around the most at-the-money call option with the April 9th expiration, 30 days away, right now is trading at about a 20% implied volatility. And the VIX right now is trading around a 22% implied volatility. So if you think about it, Johnson & Johnson has less volatility as a pharmaceutical company right now than the S&P 500 index. So that's just something that kind of hang your hat on. So what does that mean to me? That means to me, I don't mind buying some option contracts. I don't feel like I'm paying inflated vol as opposed to just even buying the SPX options outright on a 30-day basis. So here's what we're going to do. If you weren't necessarily thinking about buying 100 shares of Johnson & Johnson, you didn't want to pony up the $15,900 to do that, what's another way that we can participate? And I've been selling these type of trades since the pandemic as a FOMO trade, fear of missing out, FOMO. And this is one way we can do it. Now, you can pick the expiration that you want to go out to, and i.e., the more time is more money. But if I go out to the June 18th expiration, the normal third Friday of the month in June expiration date, that is exactly 100 days away, which is just a fun number overall. So why not pick the 100-day option contract? And we need something that's going to act like the stock. So we need a stock surrogate. To me, that means we need delta. If I look at the 145 strike call with the stock trading fairly close to 160 right now, so about $15 in the money, I see that that is trading, and I'm going to give you both sides of the market. It's bidding 1680 and asking 1715. Okay, so obviously a wider market than the underlying stock, which is a penny wide. You do have some decent volume. We got about 60 some contracts that have traded. Open interest right around 645. So the markets are okay overall for this option contract. They're not great. They're not better than the stock. You'd think that maybe if you worked it, maybe you could fill something a little bit closer to the midpoint of it. I'm going to call the price. I'm going to lean towards the ask. I'm going to call the price $17 to make the math simple overall. If you just put a market order in right now, in theory, you should get $17.15 or $1,715. Okay. So if we pay $17 for it, that means we are getting something that acts like the stock and acts like the stock. It gives you about 80% of the stock representation. How do I know that? Is because I look at the delta, and you can think of delta as a number of shares of stock. If you bought 100 shares of stock, you'd pay $15,900 some odd dollars, right? But if the stock went up one, you would make $100. That would be the concept. Delta, in theory, says, well, I'm not going to pay as much. I'm not going to buy 100 delta option contract. I'm going to buy the 80 delta. But that does mean that my option contract represents 100 shares of stock. And if the stock goes up one, my option contract should go up 80 cents or basically act like 80 shares of stock. So if I'm looking at deeper in the money option contracts 100 days out, see if this vaccine, if Johnson & Johnson becomes the winner and they decide to use this vaccine to distribute it across the world and try to get this pandemic under control. Overall, we're still a long ways away from being at that situation, especially if you consider third world countries and everybody else in the world that needs to get this vaccine. Johnson & Johnson would give you 100 days to see what scenario plays out, see how this all happens. You will have limited risk. So ideally, if I bought Johnson & Johnson and I just look at the chart, $17 is a decent move in Johnson & Johnson, but it's done that to the upside and to the downside ever since the downturn in March. There's been quite a few wild swings. So a 17-point swing on a $160 stock is about 10%. Is it possible you could lose 10% by buying 100 shares on Johnson & Johnson? Yes. But guess what? If you use the option, that's all that you can lose, right? So I'm billing this as if you were thinking about buying 100 shares of Johnson & Johnson, but you just didn't want to pony up all the cash. This is one way that you can participate, and you will know your exact risk when you put this trade on. Now, I've always proposed these FOMO trades as, well, you want to set an alert. The underlying stock does come down to the 145 level. It trades somewhere between 140 and 145. A lot of times you just want to get out of the trade. Now, one of the beautiful things about an in-the-money leap option contract is that on the way up, you gain delta. In other words, we start with an 80 delta, and if it becomes more in the money, eventually that delta is going to approach 1, meaning it's going to act a lot like the stock getting deeper and deeper in the money. Now, when that happens, the bid-ask spread usually widens, and that's a downside of it. Overall, is you have to kind of work that order, and that's the biggest headache with buying leaps as a stock substitute. But on the way down, the deltas go against you slower. So we start out with an 80 delta, but as the underlying stock goes down and gets to, let's say, the strike price, 145 here in our case, we actually, the option contract actually starts moving slower. So it hurts you less as the market goes against your position, and it helps you more, and then I'm talking about delta, as it goes with your position. All right. So if you think about it, if option contracts overall had tighter markets, on in the money longer term options, there would be a lot more people that would be interested in this strategy. It's really all about the bid-ask spread. You're limiting your risk. You're getting a benefit of if you're incorrect on your forecast, the option doesn't go against you as quickly as the stock would. But if you're correct on your forecast, it goes with you quicker. But you got to deal with bid-ask spreads. And especially the deeper you get in the money, the wider the spreads get overall. So one last little thing that I need to talk about on our little FOMO trade on Johnson & Johnson is that, first of all, it's not meant to be a recommendation. If you're going to trade leap options, I mean, one of the biggest things is to actually just watch the bid and ask. And that's why we call it a paper trade. You need to understand that liquidity risk that's involved with buying deep in the money, longer term option contracts. Now, also, we still bought an 80 delta. We didn't buy a 1 delta option contract. We didn't want to pay up for that overall. So we still do have some time premium. And if I just round off right now, the time premium is right around $2.50. So ideally, if I'm going to do this trade, I would like to whittle away at that time premium. And that strategy is called a fig leap inside the options playbook. That means I bought this longer term, 100 days out in the money, leaps call option. Now, once again, just to recap it, we're buying the 145 strike, June 18th expiration call option with an 80 delta. It's trading right around $17. We're going to call it $17. The markets are moving right now. That means we have $1,700 that we have to pony up. And we got to remember commissions, and that will be our max risk. Now, if you want to try to whittle away at that time premium, you can sell shorter term options against it. You have the right to buy the stock at 145. It's a right, not an obligation, but you have something that acts a lot like the stock. Now, we could do something similar to a covered call on the stock by selling a near term option against it. But one of the biggest things is you don't own the stock. And that's why we call it a fig leaf, because we like to say you're kind of covered. In theory, you're covered because you can buy the stock at a lower price than where you take on the obligation to sell it. But if you do get assigned, you have to do something because you don't own the stock right now. So you either got to exercise your option, you got to sell your option, buy the stock. You have something that you have to do with it. So it makes it a little bit more complicated. So if I'm selling a call against my long option contract, I just want to make sure I don't get assigned. I'm going to try to manage that risk. Now, you can't always, the world's unpredictable, obviously, so you can't always 100% manage that type of risk. But I'm going to err to the side of maybe going further out in strike, going higher in strike price, and give up a little bit of premium overall. So just going out right now, just looking at the same chart with the stock right around 160, we can go and sell the 165 9-day option contract and get 50 cents for that. So that would whittle 50 cents worth of time premium. The market on the 165 right now is 50 cents by 51. 50 cent bid by a 51 cent ask. So liquid market, you could sell that. That means that if it gets to 165, you're going to have to do something. We're doing shorter term. We're going over the next 9 days. And I definitely would want to avoid earnings. By the time earnings comes around, I would like to be done with my kind of covered call strategies. I might do another 9-day. Once that expires, maybe do another 9-day. Just overall, I'm getting decent premium. As long as I can get decent premium and I can whittle away at that $2.50 worth of time premium, I would consider doing that overall. But realize you are capping your upside when you do that trade. Right now, the anticipated earnings date is going to be around April 20th. So you want to make note of that on your calendar. I do not want to be in a covered call position that caps my upside, or I should say a fig leaf position that caps my upside going into the earnings announcement overall. It caps my upside, but gives me all the risk to the downside of owning that option contract. So what was today's trade? Well, it's kind of fun. Just look at the good old-fashioned buy a call option on a stock that you wouldn't mind owning. And how do we do that? We want to buy something that acts a little bit like the stock. We're going to pay up for some delta. We're going to go a little bit further out in time. And we're going to buy an 80 delta option contract in JNJ. All right, that's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, you send them directly to me at theoptionsguy@invest.ally.com. Please check me out on Twitter. My handle is @BrianOverby. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.